Welcome back to the Market Podcast. Asymmetric info for individual investors. Educational info only, not financial or legal advice. Consult a pro before investing.
Imagine a healthcare system designed not by bureaucracy, but by brilliant minds with a passion for simplicity. One that actually makes you feel like you finally have a doctor in the family, not, a call center.
Right.
Today, we're dissecting a company that claims to do just that. And more importantly, asking, is this the next major investment opportunity hiding in plain sight? We're talking about Oscar Health, ticker OSCR, a true disruptor that's navigated the maze-like world of health insurance, transforming from a scrappy startup into a genuine Fortune 500 player.
Quite a journey.
The question isn't just what is Oscar Health, it's why are some of the sharpest minds in finance, including its own founders, pouring serious money into this company right now?
That's the real question.
Are they seeing a runaway success, or is there a layer to the story we haven't yet appreciated?
That is the absolutely critical question for anyone looking to understand where healthcare is truly headed and perhaps where their investment dollars could find a home. This isn't just about another company. It's about a bold vision attempting to fundamentally redefine an entire industry that, for many, has been a source of endless frustration.
Absolutely.
We're going to pull back the layers on every facet of Oscar Health, from its groundbreaking leadership to its unique business model, and of course, the cold, hard financials that tell the real story.
Given Oscar's audacious goal to simplify healthcare, it makes you wonder, who are the people bold enough to take on such a challenge? Let's start by looking at the titans and tech visionaries steering this ship.
Makes sense.
Because in any company aiming for true transformation, it always starts at the very top.
Indeed. The leadership team at Oscar Health is a fascinating, almost paradoxical blend of seasoned healthcare expertise and cutting-edge technological innovation.
Okay.
Leading the charge as CEO since 2023 is Mark T. Bertolini. This individual is nothing short of a healthcare titan.
Right. The name definitely rings a bell. Aetna, wasn't it?
Exactly. He previously steered Aetna as its CEO from 2010 all the way through its massive $69 billion acquisition by CVS Health in 2018.
Wow.
During his tenure, he famously transformed Aetna into a profoundly consumer-focused powerhouse. Before that, he held significant executive roles at other major players like Cigna, NYL Care Health Plans, and Select Care.
So, real industry heavy hitter.
Absolutely. At Oscar, Bertolini's strategic vision is vividly evident in the company's recent market expansions and, crucially, its profitability gains.
We'll definitely dig into that profitability later.
We will. And if you want a layer of personal grit to his story, consider this. He overcame a severe skiing accident in 2004 that broke his neck, turning to alternative therapies to regain function.
No kidding.
That unique, first-hand perspective on the healthcare system undoubtedly adds a certain determination and empathy to his leadership.
It's fascinating to see a former Aetna CEO at the helm of a disruptor. You've seen the industry from the inside out. What's the biggest challenge in bringing that established wisdom to a nimble, tech-first startup like Oscar?
That's a perceptive question.
Is it truly a clean break from traditional healthcare, or are there still fundamental similarities that even Oscar has to grapple with?
It's not just about one person. While Bertolini brings unparalleled industry savvy, the challenge is always merging the best of traditional practices, like managing risk and complex networks, with the agility of a tech startup.
Okay.
And that's where the complementary genius of Mario Schlosser comes in. He's a co-founder and served as Oscar's CEO until 2023.
Right, the original tech guy.
Exactly. He strategically transitioned to Chief Technology Officer. This move was very deliberate, allowing him to focus exclusively on Oscar's proprietary tech platform, which is, in many ways, the company's foundational engine.
Makes sense. Focus on the core strengths.
Precisely. Mario possesses an incredibly impressive technological background. Computer science degree from the University of Hanover, MBA from Harvard Business School.
Wow.
He's also no stranger to entrepreneurial success, having co-founded Vostu, which became Latin America's largest social gaming company.
Interesting background. Gaming to healthcare.
And he honed his analytical skills at institutions like Bridgewater Associates and McKinsey & Company. To underscore his deep tech prowess, he's known for developing the eigentrust algorithm.
Sounds complex.
It might sound technical. Essentially, it's about establishing trust in decentralized networks, a foundational skill for building robust, secure digital systems like Oscar's.
Got it. So that's the core partnership.
So, while Bertolini brings the how healthcare works, Schlosser brings the how technology can make healthcare work better.
So we have a healthcare heavyweight and a tech genius. That sounds like a dream team on paper. But are there ever challenges in bringing such different perspectives together, or does their combined expertise simply unlock more potential?
It's certainly a powerful combination.
And who else is crucial to this team, ensuring all cylinders are firing?
Well, the challenge lies in seamless execution and clear strategic alignment, which they seem to have mastered. They've built a robust executive team around them.
Okay, who else is key?
You have Scott Blackley as CFO, bringing extensive financial strategy from his time at Capital One. Janet Liang serves as EVP and president of Oscar Insurance, meticulously managing the core insurance operations.
Essential roles.
Absolutely. Navigating the incredibly complex regulatory landscape, especially in an ACA-driven market, is paramount. Rinmali Bopitia is Oscar's EVP of Public Affairs, handling just that.
Critical in healthcare.
And on the clinical side, you have Dr. Okiki Louie, president of Oscar Medical Group, ensuring clinical excellence, and Dr. Sean Martin, the chief medical officer focused on care quality.
So a well-rounded team.
Exactly. This blend of deep industry know-how, sharp financial acumen, crucial regulatory expertise, and clinical leadership truly positions Oscar to fundamentally disrupt traditional insurance models, not just nibble at the edges.
That's a strong operational team, but what about the original visionaries? In a company built on a disruptive idea, you have to ask, are the original founders still intimately involved?
That's a critical question, and the answer is yes. 2 of Oscar's 3 original founders remain very much active. Mario Schlosser, as we discussed, continues to drive technological innovation as CTO.
Right.
And Joshua Kushner, the founder of Thrive Capital, serves as vice chairman, providing critical strategic oversight.
Still involved at the board level.
Yes. The third co-founder, Kevin Nazemi, did depart in 2015. But the continued active involvement of both Schlosser and Kushner is significant for investors.
Why is that so important?
It aligns with a well-observed trend. Founder-led companies often tend to outperform. Their initial vision and personal stake fuel long-term growth and commitment. It's a powerful signal.
That's a powerful vote of confidence when founders stick around. But beyond just their presence, what truly motivates these leaders? How exactly are their interests aligned with ours as potential investors?
You've hit on a crucial point, alignment.
Because ultimately, you want the people running the show to win when you win.
Right. Oscar's executives are highly incentivized through a mix of cash and, more importantly, substantial equity awards. This directly aligns their financial interests with shareholders. If the stock does well, they do very well.
Can you give us an example?
Sure. In 2023, Mark Bertolini's total compensation was reported at a staggering $44.5 million.
Wow.
But the overwhelming majority, $43.9 million, was in stock awards.
Okay, so heavily weighted towards equity.
Very much so. Mario Schlosser also received considerable compensation, $10.8 million total, with $9.2 million of that in equity. Others, like CFO Scott Blackley, also received substantial equity.
So it's not just the top 2.
No, it permeates the executive team.
Right.
This heavy equity weighting encourages long-term value creation, calculated risk-taking, and innovation. It's different from some peers where cash might be a larger component.
That makes sense. What about the pay ratio? Sometimes you hear about that.
It's worth acknowledging. The CEO to median worker pay ratio was high in 2023 at 455.1. But this is often typical for growth-focused companies where top talent is heavily compensated for driving significant shareholder value.
Okay, understood. Beyond compensation, what's the fundamental driving force? What's the mission that shapes the company and its culture?
At its core, Oscar's mission is ambitious: to make a healthier life accessible and affordable for all. They talk about acting like a doctor in the family.
That's a nice aspiration. How does it play out?
Imagine getting proactive support, personalized resources for managing diabetes, help finding a specialist easily. That's the goal. Their vision is revolutionizing insurance via technology, transparent pricing, personalized care.
Does that translate to the culture?
It seems to. They foster a fast-paced, innovative, collaborative environment, open offices, things like that. Employees seem motivated by this goal, seen in initiatives like care journeys for diabetic members.
No journeys without bumps, especially in healthcare. What potential challenges does this leadership team face? What keeps them up at night?
There are definite risks. Succession planning is always a concern, especially with Bertolini playing such a pivotal role.
Sure.
There's also potential over-reliance on Schlosser's tech expertise, though the 2023 CEO transition was remarkably smooth, which is a good sign. But future changes could disrupt strategy. And externally, regulatory pressures are relentless, plus the constant need for profitability in a volatile industry demands exceptional agility. It's a tightrope.
How does Oscar's leadership stack up against the Goliaths,
They-
like United Health or Cigna? Can they truly compete?
It's an illuminating comparison. Oscar's leadership is leaner, far more tech-focused. They lack the sheer scale of the giants, obviously.
Right.
But Bertolini's Aetna experience rivals any top CEO. What really sets them apart is Schlosser's tech background, providing an innovation edge that's hard for traditional insurers, often burdened by legacy systems, to replicate quickly.
So agility is key.
Exactly. Oscar can pivot much faster due to less bureaucracy. While a big insurer might take months or years for a new feature, Oscar can potentially do it in weeks. That's a significant advantage.
You've met the brilliant minds. Now let's peel back the layers on how this company actually operates. How does Oscar Health demystify insurance for you, the everyday person?
Oscar's basic model is straightforward. Sell health insurance plans to individuals, families, small businesses.
Okay, standard enough. But the difference is the technology-driven, user-friendly process. Think ordering from your favorite app, intuitive, transparent, personalized. That's the aim.
How so?
Features like integrated telemedicine, a comprehensive mobile app that actually works, clear pricing, all aimed at demystifying healthcare, making it less bureaucratic.
So simplifying the front-end experience.
Profoundly simplifying the member-facing interaction. Now, underlying financial nuances like medical loss ratios or reinsurance might still be complex for the average person, but the experience is streamlined.
So what specific plans are they offering and who are they reaching across the country?
They focus on individual and family plans, small group plans, and in select markets, Medicare Advantage. Their reach is extensive, over 2 million members across 18 states currently.
2 million members is significant.
It is, and beyond just insurance, they develop the Plus Oscar platform. This provides tech solutions to other healthcare organizations, licensing Oscar's tech to help them improve engagement and efficiency.
Ah, so like a B2B tech offering as well. Exactly. It's a crucial diversification of revenue streams. They've also been innovative with products, launching plans like Buena Salud for Hispanic and Latino members, and multi-condition plans for chronic diseases.
Shows they're targeting specific needs.
Right. And maintaining 1.7 million members in 2024 with strong revenue growth indicates good product market fit.
Beyond the plans, what makes Oscar truly different? What's their actual magic ingredient, their secret sauce?
Their magic ingredient is blending cutting-edge tech with relentless member-first philosophy. Unlike traditional insurers with clunky old systems, Oscar uses a full-stack tech platform.
What does full stack mean in this context?
It means they build and control every layer of their technology, from the app you use to the complex back-end operations. Deep integration, not just an add-on.
Okay.
This allows seamless innovation, data leverage. It enables virtual care, personalized care teams, even step tracking rewards. And the Plus Oscar platform licensing their tech to others adds another layer of uniqueness.
So it's fundamental to how they operate.
Absolutely. It aligns with their passion for simplifying healthcare, drives premium revenue, and positions them to potentially lead in customer experience.
Sounds great on paper, but track record matters. What's their story so far? Key milestones.
It's been eventful. Launched 2013, secured 16,000 members, first year, strong start. Expanded to project 18 states by 2025. Went public in 2021.
Right, the IPO.
But the most pivotal achievement, 2024, their first full year of profitability.
That's huge. We keep coming back to that.
It's monumental. Plus, developing Plus Oscar broadened their tech footprint. And they've shown adaptability, exiting unprofitable Medicare Advantage markets to refocus strategically on ACA plans. They learn and pivot.
How do they operate day to day? Physical presence, infrastructure.
Headquartered in New York City, operating in 18 states, they have a big operational hub in Tempe, Arizona for their concierge team handling member services.
Okay.
Operations are centralized around their tech platform. They partner for provider networks, not owning facilities. Keeps them lean, avoids massive capital spending.
That's crucial. So to be clear, no hospitals, no pharmacies. Purely tech and insurance partnering with others.
Absolutely correct. Focus is solely on insurance and tech. No owning hospitals or pharmacies. Strategy revolves around partnerships, like the Oscar Center with Mount Sinai for primary care.
So an asset-light model.
Exactly. Enhances flexibility, rapid scaling. But it means reliance on external providers, unlike vertically integrated competitors like United Health. Trade-offs.
How do they get plans into your hands? Distribution model?
All digital, multi-channel, but with a distinct digital-first emphasis, direct via website and app, seamless, modern, also through traditional brokers, recognizing the channel's importance.
Okay.
And critically, on the ACA exchanges, a major avenue for individual and family enrollments. Tools like the Oscar Broker portal streamline things for brokers too.
So leveraging tech even in traditional channels.
Yes. Supports scalability and customer retention through a better user experience.
Can we count on their revenue stream?
Huh.
How predictable is income in this dynamic industry?
Predictability is relatively strong, especially premiums. That's the bulk of their income, reaching $9.2 billion in 2024. Highly predictable. The Plus Oscar platform adds another layer. Income from tech contracts can be more variable, but it strategically diversifies the revenue base.
And the recent profitability helps stability?
Strongly suggests more stable cash flows. But it's healthcare. Medical costs can fluctuate, introducing variability into ultimate profitability. That's the tightrope.
What are the biggest dangers lurking? The monsters under Oscar's bed.
The primary concern, the biggest monster, is always regulatory changes, especially affecting the ACA. Shifts in subsidies or mandates could directly impact their core market.
That seems like the elephant in the room for any ACA player.
It absolutely is. Then there's intense competition giants like United Health, plus nimble new entrants. Cybersecurity risks are constant given their data-driven model.
Always a worry with health data.
And broader factors like drug price regulations could indirectly impact cost.
Despite these threats, how resilient is Oscar? How well equipped are they to weather storms?
They've shown remarkable resilience, primarily due to their core strength, the tech platform. It enables rapid adaptation seen in strategic market exits and swift new plan launches.
They're not afraid to change course.
Exactly. Focus on member satisfaction builds loyalty, a cushion against market shifts. And achieving that first profitable year in 2024 is powerful evidence of anti-fragility.
Anti-fragility, explain that.
Think of it like this. Fragile breaks under stress. Robust resists stress, but anti-fragile improves under stress. Oscar, learning and refining its model, demonstrates an ability to grow stronger through challenges. Rare trait.
Every great company has a secret weapon, a competitive advantage, a moat. What gives Oscar its edge in this crowded market?
Oscar has built an impressive moat. While not a monopoly, they have a strong ACA market position due to tech and customer focus. 1.7 million members isn't niche.
So what are the key elements of that moat?
Counter-positioning is perhaps the most profound. Their tech-centric, transparent approach contrasts sharply with legacy insurers' opaque, complex nature. They built tech first, then insurance.
So incumbents can't easily copy it.
Virtually impossible without tearing down their entire infrastructure. It's an architectural advantage. Then there are powerful network effects. Larger membership strengthens provider negotiations, potentially lowering costs.
Makes sense.
The Plus Oscar platform also benefits from more users. The more people using Oscar, the better it gets. Their proprietary technology is obvious. The full-stack platform enables virtual care, analytics traditional insurers struggle with.
It's bespoke, not off the shelf.
Exactly. And don't underestimate process power. Streamlined operations via tech reduce costs, improve member experience. A distinct advantage over bureaucratic rivals. Imagine insurance where things just work smoothly.
They've weaponized agility and transparency.
Precisely. Redefining the playing field, forcing incumbents to choose, costly overhaul or lose share.
These advantages stand out, but are they sustainable? What stops a giant from buying a tech solution or a competitor leapfrogging them?
That's the real challenge. They're sustainable if Oscar maintains tech leadership and customer trust. Their innovation speed is a defense.
Why can't incumbents just buy tech?
Because Oscar's tech is deeply ingrained in its processes and culture. It's not just software, it's how they operate. But the market is relentless. New tech entrants could emerge. Regulatory shifts are a wild card.
So continuous innovation is key.
Absolutely. Never resting on laurels. It's an ongoing battle.
With these advantages, where is Oscar heading next? What's their roadmap for expansion?
Aggressive and multifaceted. First, market penetration deeper into existing states. Second, ambitious market development aiming for 504 new counties in 2025 alone.
500 new counties? That's massive.
It's audacious. Signals intend to capture share rapidly. Third, continuous product development, launching specialized plans like Buena Salud, multi-condition plans, catering to diverse needs.
Not just generic plans.
Right. And finally, diversification by growing the Plus Oscar revenue stream. Reduces reliance on premiums, taps the broader health tech market, another growth engine.
500 new markets is incredible. How much room is there for them to actually grow? Are we talking a corner of the market or something vast?
The potential is immense. The U.S. health insurance market is colossal, hundreds of billions annually. Huge addressable market for Oscar, especially in ACA and small group segments.
So they're just getting started, relatively speaking.
Absolutely. With 1.7 million members in 2024, they have significant headroom. The opportunities are substantial, just scratching the surface.
How versatile is their core tech and business model? Can it adapt, or is it specialized, creating limitations?
Highly versatile and scalable. Insurance plans serve broad markets, but the true versatility comes from the Plus Oscar platform. Extends tech reach to other providers and payers.
So beyond just selling their own insurance.
Right. It's about Oscar providing the tech engine, empowering other organizations, bolsters their brand, creates new revenue avenues, a robust, adaptable model, potentially an enterprise software powerhouse, too.
What about the operational backbone? Expanding provider networks for that growth, is that a bottleneck?
Critical point. Oscar's supply chain is its provider network, managed via partnerships. Expanding into 504 new markets requires robust networks.
That sounds challenging.
It is. Requires significant negotiation, relationship building, careful management, and area investors must monitor closely. It's the ground game supporting the Tech Air campaign.
Are they putting all eggs in one basket? Or is the customer base diverse?
Thankfully, commendably diverse. Serving individuals, families, small businesses across 18 states mitigates reliance on any single segment or demographic. Provides resilience. Smart strategy.
Looking far out, 5 or 10 years, will Oscar still be around, or a fleeting trend?
Health insurance is a perennial need, not going anywhere. Oscar's tech focus aligns perfectly with the irreversible trend toward digital health.
So you think they have staying power?
I'd assess its likelihood of remaining relevant at a strong 80% probability. The primary wildcard remains major regulatory upheaval, especially ACA changes. Barring that, their tech-driven model is built for the future.
So to summarize, what are the primary engines propelling this growth? What should listeners watch?
Main engines. First, aggressive geographic expansion. Second, continued membership growth. Third, increased adoption of the Plus Oscar platform, significant value driver. Fourth, successful launch of new specialized products. Those 4 pillars.
And what could put the brakes on this trajectory? Main risks to growth.
Unfavorable regulatory changes, especially impacting ACA. Intensified competition from giants and new entrants. Economic downturns impacting enrollment. And operational scaling challenges with rapid expansion. Growth is great, but needs meticulous management.
Numbers never lie. Let's dive into the financials. What do the cold, hard figures tell us about Oscar's recent performance and health?
Indeed. The financials show robust growth and that significant turning point. Let's break it down. Revenue growth, phenomenal. 56.5% year over year in 2024, reaching $9.2 billion.
Still strong in Q1 25.
Yes, momentum continued. Q1 2025 revenue of 42% year over year to $3.05 billion. Explosive growth driven by membership expansion.
Okay, and the big one, profitability.
Net profit margin, modest 0.28% in 2024, but jumped significantly to 9% in Q1 2025. Their first full profitable year. Monumental achievement. Investment starting to pay off.
What about the Rule of 40? How do they score?
The rule of 40%, growth rate plus profit margin, they scored an impressive 58.5% in 2024 and 51% in Q1 2025. Consistently exceeding 40% signals powerful growth and improving profitability work together.
Healthy combination. What else stands out?
Return on equity, ROE, 2.5% in 2024, healthy for just turning profitable. Debt to equity, very manageable, 0.295, not overly leveraged. Book value growth, strong 26% in 2024.
And key insurance metrics like MLR.
Medical loss ratio, MLR, 81.7% in 2024, 75.4% in Q1 2025. Q1 affected by prior period adjustment.
Very competitive.
Shows about 82 cents of every premium dollar goes to member care. Efficient cost management.
Good to see. What about overhead?
SG&A expense ratio,
F2.
remarkable improvement, tightening from 19.1% in 2024 to 15.8% in Q1 2025. Signals operational discipline, increasing efficiency as they scale, getting leaner as they get bigger.
How do these impressive numbers stack up against the giants? Are they playing in the big leagues now?
Compared to larger peers, Oscar's revenue growth significantly outpaces many. Now, its net profit margins still lag giants like United Health, largely due to scale differences.
Makes sense.
But Oscar's MLR is competitive, and SG&A improvements are strong signals they're achieving discipline and improving profitability while growing, quickly closing the gap.
So overall trajectory, one-off wins or a sustainable trend? Flash in the pan or new era?
Trends strongly suggest sustainable upward trajectory. No flash in the pan. Steady revenue and membership growth underpin it. But the critical achievement, first profitable year in 2024, strengthened in Q1 2025, signals the model is maturing and sustainable.
So investments are translating to the bottom line.
Precisely. Hitting its stride.
Now for the ultimate question. What's Oscar Health actually worth? Hidden gem or market, already too enthusiastic, potential bubble?
This is where we assess investment potential. Valuation is key. Buying below intrinsic value provides that crucial margin of safety against volatility or miscalculations. It guides decisions.
How do we value a company like this? Unique position, recent profitability, aggressive growth. Not simple.
For a growth company like Oscar, recently profitable but expanding aggressively, relative valuation using PE and PB ratios is often most suitable.
Why not DCF?
DCF can be less reliable with potentially volatile or rapidly accelerating cash flows. Forecasting becomes highly speculative. Relative valuation compares Oscar to peers and the market, giving a good sense of current standing.
Let's hear both sides. Pessimistic view. The bear thesis.
Bears worry about intense competition squeezing margins, making sustained profitability difficult. They might argue recent profitability is a fluke, not persistent.
And regulation.
Huge concern. Significant ACA regulatory risks loom large, threatening their core market. Bears might also point to high PE and PB ratios, suggesting overvaluation already.
So growth priced in.
Potentially. And finally, continuous cybersecurity threats pose a real risk to their data-driven operations. A major breach could be catastrophic.
And the optimists, the compelling bull thesis, why could this be a home run?
Bulls point to robust 56.5% revenue growth, 2 million members, undeniable momentum. Their proprietary tech platform is a true differentiator, driving efficiency, engagement, a powerful moat. Ambitious expansion into 504 markets promises significant future growth. Strong insider and institutional buying reflects immense confidence from those closest and with deep research capabilities.
That's a strong signal.
Very. Lastly, diversification via the Plus Oscar platform enhances resilience and offers new growth avenues, almost two businesses in one.
Considering both sides, bears and bulls, what's the most probable scenario? Destined for glory or fraught with peril?
Weighing both, the bull case seems more likely. Impressive growth, critical profitability achievement, robust insider support. These aren't minor points. Significant validation.
So they're delivering results.
Yes. But it's crucial to acknowledge regulatory risks, temper excessive optimism, requires vigilant monitoring. Powerful growth story, but operates in a highly regulated, changeable environment.
So after all that analysis, where does the stock stand right now? Buy at current price or wait?
Let's look at numbers as of June 20, 2025. Share price around $21.43. Market cap $5.36 billion. 2024 EPS was 0.10 cents. Okay. But here's where it gets really interesting. Projected 2025 EPS is a massive jump to $1.
Wow, big jump. What does that mean for valuation?
Gives a forward PE of roughly 21.43. For a company growing this fast, just turning solidly profitable, that seems quite reasonable. Signals market sees future potential.
What about price to book?
PB is 5.28. High side, yes, but justifiable by strong growth prospects and the value of their proprietary tech not fully captured by book value.
How does that compare to analyst targets?
Analyst targets average around $18.56, suggesting slight current overvaluation by consensus. However, strong Q1 25 results might warrant higher valuations. Analysts could be playing catch-up.
So the verdict on valuation?
Appears fairly valued, or perhaps slightly undervalued, offering a modest margin of safety for patient, long-term investors.
The market's always moving. Freshest developments, conversations around Oscar right now. What do investors need to know?
Recent buzz is significant, especially strong signals from within. Key development, insider buying. Directors, including Schlosser and Bertolini's foundation, bought significant shares in 2025. Deep conviction.
How significant?
Bertolini's foundation alone bought nearly 1 million shares, 933,333. Kushner's Thrive Capital holds over 6 million. These aren't small bets.
That's serious commitment. What else?
Major milestone. 2025 entry into the Fortune 500 boosts credibility, visibility, cements their status. Looking ahead, crucial Q2 2025 earnings in early August. Pivotal moment for sentiment.
And execution.
Actively executing market expansion, aiming for those 504 new markets in 2025, launching new plans like Buena Salud, demonstrating active, aggressive growth right now.
So what's the word on the street? Are investors buying the story?
Prevailing narrative is largely bullish. Investors cite the impressive 67% revenue CR, potential for $1 billion free cash flow, a huge target. Insider buying is a key optimism driver.
Comparisons to other growth companies.
Yes, like hims and hers. Commentators note Oscar's higher risk, but also greater perceived potential for transformative growth. Concerns about regulation and valuation exist, but optimism dominates. The story and numbers are resonating.
So the big question, are insiders and institutions betting on Oscar because it's a breakout star? Or just hype? Real deal?
Evidence points clearly. Insiders like Bertolini and Kushner are buying because they likely see Oscar as a breakout star, not casual investment, profound confidence.
The scale backs that up.
Absolutely.
Right.
Nearly 1 million shares for Bertolini's foundation, over 6 million for Kushner's Thrive. Institutional investors hold 75.7%, added over $905 million in the past year. Vanguard's a key holder.
So not just flashy moves.
Not just flashy, backed by strong fundamentals. 56.5% revenue growth, first profitable year, ambitious expansion underway. Real, tangible progress, transforming from promise into performer.
For you, the individual investor, absolute key truths to remember. Bottom line.
4 critical truths. First, tech advantage. Proprietary platform is core strength, drives engagement efficiency, creates significant moat. Hard to replicate.
Okay.
Second, ACA growth. Expanding ACA market fuels membership, ample growth runway, a built-in tailwind. Third, demographic focus. Targeted plans like Buena Salud show intelligent growth strategy, not scattershot.
Smart targeting.
Fourth, plus Oscar potential. Diversified revenue reduces premium reliance, adds resilience, new growth avenues, like a second business line expanding.
And the non-negotiable risks you must keep in mind, ignoring them is disaster.
Absolutely. Key risks. Regulation. Future ACA changes under new administrations could disrupt. Biggest wild card. Second, competition. Giants and nimble entrants are constant threats. Third, cybersecurity. High-tech reliance invites data security risks. Requires continuous investment vigilance. Fourth, execution. Scaling into new markets needs flawless operational capacity. Best strategy is useless without perfect execution.
Finally, lingering questions. Uncertainties only time can answer. What should we keep pondering?
Biggest uncertainties. Long-term impact of future regulatory shifts. Healthcare policy is dynamic. Also, potential for further tech disruptions. Will they benefit Oscar or challenge it?
Right.
And broader economic impacts on enrollment and affordability remain unknown. Downturns could affect membership regardless of tech prowess.
Oscar Health is clearly a fascinating blend of technology and healthcare, carving its own unique path. Its journey from startup dream to profitable Fortune 500 company in just over a decade is remarkable.
Truly remarkable.
The strong conviction shown by insiders and institutions suggests they believe deeply in its future. But as always, the future is never written in stone. This has been insightful.
Indeed. The company's story is a powerful reminder that even in entrenched industries, innovation, strategic leadership, and relentless customer focus can revolutionize the landscape.
Leaves you thinking.
It leaves us with a compelling thought. As healthcare continues its undeniable digital evolution, how will companies like Oscar truly redefine what it means to be insured? And what role will technology ultimately play in making healthcare genuinely accessible and affordable for everyone?
That's a question worth pondering long after this conversation. Keep digging, keep learning, and keep asking the big questions. We'll see you next time.
Love this? Drop a like, subscribe, and ring the bell so you never miss a podcast.